For many, there appears to be a mismatch between the soaring heights of stock market indices and the realities of their day-to-day living. Certainly, there is a degree of cognitive dissonance between everyday challenges of facing the cost of living and the sight of stores closing their doors, while the media shows images of the yachting classes enjoying a rising tide. So why is there such an apparent disconnect between Wall Street and Main Street? And can we take the valuations of stock markets as reliable indicators of national prosperity? While stock markets are not intended to reflect living standards directly, they are taken as a marker for national prosperity. The Buffett indicator, synonymous with the Sage of Omaha, is calculated by dividing the total market value of all publicly traded stocks in a country by that country's GDP, and is usually expressed as a percentage, although the revenues of many listed corporations are global rather than national. It may have been intended as a wry commentary on stock market exuberance, as its highs historically precede stock market crashes. Currently, it sits at a record high of 237% of GDP, a concerning portent for many commentators. Stock prices are classically deemed to be determined by a company's quarterly earnings report, as well as any market optimism for its prospects. And this is reflected in the so-called share price to earnings ratio, which varies between sectors. Historically, the PE ratio average has hovered at around 16, although this has since increased to closer to 20. However, a recent spate of tech and AI company valuations has led to concerns, with a stock market IPO valuation of over 1,000 times actual earnings reached for Tesla in 2020. Much of the current concern revolves around circular finance, where tech companies, suppliers, and investors mutually finance one another's growth. For instance, NVIDIA invests in OpenAI, and OpenAI then uses those funds to buy chips from NVIDIA, artificially inflating the effective investment and sales of both companies. Another bone of contention is that of share buybacks, which inflate stock market indexes primarily by shrinking the number of available shares, mechanically boosting PE ratios without any underlying business growth. When companies fund this practice with cheap debt, it allows them to engineer continuous stock price increases while potentially diverting funds away from long-term capital investments in growth or employee wages. Aside from masking modest economic performance and enriching shareholding executives, this practice promotes market exuberance and increases their debt, making them more vulnerable to economic shocks. A further source of stock market inflation derives from the rise of private equity, which has injected a vast wave of liquidity that ripples directly through public markets. Private equity firms routinely buy entire public companies, offering premium prices, often 20 to 40% above market value, to take them private, increasing the competition for remaining listed companies and driving their valuations up. A further reason for the record rise in stock markets is a decline in reliance on fixed income. This occurs when central banks suppress interest rates, leading to conventional savings accounts and government bonds yielding returns that often fail to outpace inflation, driving investors to the higher returns of the stock market. Another factor is the rise of passive and algorithmic investing. The advent of AI-driven autonomous agents has created price-insensitive buying machines and gamified speculative stock investing. A final factor is that of corporate profit concentration, where capital tends to flow towards listed companies rather than smaller private entities, explaining much of the Wall Street, Main Street disconnect. These mechanisms help explain why stock market valuations have become increasingly detached from conventional measures of economic performance and may indicate rising cyclical risks. Regardless of any predictions, it can be logically stated that the bigger the bubble, the larger the inevitable bang, with the accidental economist predicting that the markets will fall by over 70% in the next 2 years.